A modern corporate treasury manages dozens of asynchronous bank accounts across global regions and currencies, generating a constant, fragmented stream of financial data. SAP S/4HANA Cash Operations addresses this fragmentation directly. The primary architectural objective is to pull that decentralized information into a single environment to create centralized, actionable liquidity intelligence. Looking at the standard workflow, the first step in this process is the ingestion of daily bank statements. This establishes a verified, factual baseline of the company's financial health. The system immediately utilizes those imported balances to generate a real-time cash position, providing an exact view of available funds and clearing accounts. But a workflow stopping here is incomplete. Passive reporting reveals only current liquidity, offering no predictive value for tomorrow or next week. To manage liquidity proactively, Treasury teams have to transition from passively reading today's statements to actively simulating future financial states. True enterprise liquidity control requires three interdependent pillars: real-time visibility, isolated predictive forecasting, and automated rule-based cash concentration. The first advanced pillar is prediction. Treasury must model expected cash inflows and outflows days or weeks before the actual bank statement arrive. But predictive modeling carries a significant inherent risk. Mixing unverified simulated cash flows directly with the actual corporate ledger can corrupt financial reporting and trigger severe compliance issues. S/4HANA solves this with Memo Records 2.0. This is a dedicated architecture designed specifically to simulate forecasted flows safely, keeping them structurally distinct from verified cash. However, prediction alone is still a theoretical exercise. The intelligence only has value when the enterprise physically acts on it to optimize its capital. This requires the final pillar, the cash pooling engine. This system is designed to automate the physical centralization of funds across various subsidiary accounts into central header accounts. By combining the isolated forecast data of Memo Records 2.0 with the rigid movement logic of cash pooling, S/4HANA creates a closed-loop system for total liquidity control. In the legacy state, classic Memo Records, all forecasted data was deposited into a shared operational hub. It lacked deep structural categorization, meaning every expected flow looked functionally identical to the system. This lack of granular data control severely limited precise forecasting. You couldn't easily separate a highly probable payment from a rough generic estimate. Memo Records 2.0 upgrades this architecture by routing forecasted data into a distinct, dedicated database table before it ever interacts with the main operational hub. Reviewing the import template for mass ingestion shows how strict this new environment is. Notice the mandatory category here in column A. To enter the system, every predictive data point must be assigned a specific memo record type. This creates a granular categorization matrix. Memo Records 2.0 forces the system to differentiate between different qualities of predictive data based on its source and certainty level. For example, a generic internal forecast is tagged as a planned item, but if you already have the verified bank information for an upcoming transaction, the system categorizes it as payment advice. The application processes their weight and visibility differently. Mass ingestion brings the threat of phantom liquidity. Stale, unfulfilled records sit in the system past their expected date, artificially inflating the cash position. The solution is the Memo Records 2.0 auto-expiration function. By assigning an exact expiration time upon creation, unverified forecasts automatically convert to an inactive status once that time passes. They instantly purge themselves from the cash flow analyzer. This architecture transforms the cash forecast into a dynamic, self-cleaning predictive engine that automatically removes stale information. Once the predictive layer is clean, we move to the engine that governs actual physical cash movement, cash pooling. This diagram outlines the structural requirements of a time-dependent cash pool. Every pool must contain exactly one invariable header account and one or more subaccounts. Bank-managed pools mandate bidirectional transfers, while company-managed pools allow Treasury to configure strict directional flow control. Constructing a multi-level hierarchy requires absolute adherence to systemic constraints. First rule, a bank account can be assigned as a subaccount only once. Second rule, a bank account can be assigned as a header account only once at a given time. Looking at the systemic rejection in Pool 3, Why is bank account A strictly forbidden from acting as a subaccount here? You cannot assign a bank account as a subaccount if it is already serving as a header account within the same hierarchy branch. If the system allowed this broken rule, it would create an infinite transfer loop. Cash would be continuously swept from Pool 3 up to Pool 1 and immediately back down again without ever resolving. These strict mathematical hierarchy checks are the system's primary defense mechanism. They allow for complex multinational liquidity centralization without the risk of catastrophic circular logic. With the hierarchy validated, the cash concentration algorithm steps in to calculate exact physical transfer proposals. The primary variable is the target balance. Treasury defines this as the exact amount of cash that must remain in a specific subaccount post-sweep. The algorithm measures the current verified bank statement balance against that target balance, checks the permitted transfer direction of the pool, and calculates the required movement. To protect operational efficiency, the system relies on secondary constraints, minimum and maximum transfer amounts. Setting a minimum limit prevents the algorithm from executing hundreds of insignificant microtransfers that would generate excessive, unnecessary bank fees for the enterprise. While the algorithm proposes transfers, the Treasury Manager retains final authority. They review and edit the exact amounts before final execution. The concentration algorithm eliminates the manual labor of calculating daily sweeps across dozens of accounts, enforcing absolute mathematical compliance with corporate treasury policy. We can now unify the architecture. The physical bank ledger and the predictive forecast layer operate in tandem to feed the concentration engine. The final automation mechanism that binds them is the situation template, acting as an active, system-wide watchdog for liquidity shortages. The trigger condition is precise. If the actual closing balance, combined with the available forecasted balance, breaches a predefined safety threshold, the system reacts. This threshold breach instantly sends a targeted alert to the designated internal bank account supervisor. The supervisor utilizes the alert to immediately initiate a transfer proposal within the pre-validated cash pool hierarchy, pulling funds from a header account to correct the localized deficit. This single automated action relies entirely on the self-cleaning data of Memo Records 2.0 to trigger the warning, and the structural safety of the cash pooling rules to execute the fix. Contrast this precision-engineered predictive control loop against the manual, reactive treasury models of the past. S/4HANA Cash Operations engineers a mathematically constrained environment where enterprise liquidity is proactively optimized and protected from systemic failure.